Hi guys, and welcome to part 2 of Investing for Absolute Beginners. I'm Lex, and today we're going to look at some of the questions that you have to answer for yourself before you even think about opening a brokerage account. Okay, let's get right into it. So there are 4 main things that you need to answer for yourself so that you can make an adequate investing plan. Number 1 is, what are your goals? Number 2 is, how long do you plan to invest? So what is your investment horizon? Is it 10, 20 years? Is it 5 years? It has a relevance to how old you are. Number 3, how much risk are you willing to take? How risk tolerant are you? Number 4 is, what are your earnings expectations and how much can you actually afford to invest to get to those earnings expectations? Now, there are a couple of bonus ones that I will also discuss, but we'll leave that for later. Let's get into number 1. Number 1, goals. Do you want to retire early at a younger age? Do you want to just supplement your income while you work? Because let's say you enjoy your job and you want to keep working at it, but you also want to have some side income. Do you have any savings? Are you wealthy? All of these factors kind of contribute to what kind of an investment portfolio you will need to construct, and you will need to answer these questions for yourself. For example, let's say somebody who is 20 and just is starting out, doesn't really have that much of a job which pays well. So in that case, you have someone who has a very long investment horizon. Maybe they want to retire early, so they know that they want to save as much as possible from their income so that they can build up a portfolio large enough to essentially feed them after they're retired so that they can live comfortably. To this subject, goals, it means that you have to understand what is enough money for you in terms of how much money do you want to spend per year in order to live the life that you want, that you feel comfortable with, that you aspire to. Once you have that amount, then from there we can extrapolate how big your portfolio needs to be in order to generate that amount per year. And then that portfolio size is what you have to accumulate during your portfolio building years, let's say 10 or 20 years. So in this goal section, the most important thing is for you to understand yourself and answer and be honest with yourself with the following question. How much money do I need to live comfortably or to live a life which will make me happy and satisfied? And you need to be completely realistic with that goal, because a lot of people want to make 2, 3, 4, 5 million per year, but let's face it, how realistic is that? And I would say something that most people would be very satisfied with is in the beginning of the 6-figure range. So let's say $100,000 or euros, something that you can generate passively and live very, very, very comfortably off of. Figure that amount out for yourself, and then from there we can extrapolate that we need this portfolio size to generate this amount that I need per year. Because we know, for example, an average portfolio will generate 6 to 7%. So $100,000, for example, is 6 to 7% of what portfolio size? And the answer is, and from there we have figured out your financial goal. And that is the number that you will strive to save. And depending on your age, you might have a shorter or longer time horizon to get that amount of money, so that after a while you can start living completely off of that. Or like I said, it could be that your goal is to just have some supplementary income because you love your job, you want to keep working, you want to keep doing the same thing. And from there you will basically have an idea of how you want to structure the other 3 points which I mentioned, which is how long you're going to plan, what is your risk tolerance, and what are your earnings expectations. Let's look at number 2. How long are you going to be investing? That is a very simple question which depends entirely on the age that you are and on the age that you want to retire or at least stop working as much. So obviously if you are 20 something, 30, that is the average age of where people start to think about investments more. and you plan to be working until 50, 55, 60, you have basically 20 to 20 something years to build a portfolio from which you can then use to live off of. And of course, that is entirely case dependent, but it will also lead you on to point number 3, which is risk. And obviously, the older you are, the less risk you want to take. You want to make sure that your portfolio value is not fluctuating as much, is not as volatile, and provides you a more or less regular income. While if you are younger, you can afford to take more risk, you can afford to lose money because you have time to make that up, and you can focus more on growth and more risky investments rather than somebody who is obviously older and needs to start using their money. But even in, let's say, 2 people with the same age, they will still have a different risk tolerance and will need to decide, okay, do I feel safe keeping my money in gold and bonds and stuff that is really conservative? And then there are people who would prefer to go for explosive growth to kind of catch up. They will do, for example, crypto or tech stocks or whatever. So that is something that is entirely up to you, and only you can answer that question. What type of investment and what type of risk am I okay with? And from there, you will develop kind of a risk management strategy for your portfolio, because then you can know if you are a more risk hungry investor and you put in, for example, 5% of your portfolio in a single company. If that company fails, then those 5%, well, obviously a loss, but nothing that will take you down. And at the end of those is your earnings expectations. Now, a lot of people expect that they will make 10, 15% passively from stocks. And that is true up to a point, because you can make 10% of growth of your portfolio per year, but you will not be generating 10% of cash flow in the year. Because when the value of your portfolio, of your positions, grows by 10% like it does in the S&P, then for you to actually use that money, you will need to sell a portion of your portfolio to convert to cash to then live off of. And that is not something that is very optimal unless you are already at a late age and you're not going to be keeping those investments anyway. But if you're somebody who needs cash flow, then you need to have more dividends, you need to have more bonds, you need to have assets which generate cash flow. Because if you have a company which is, for example, let's say Coca-Cola or Shell or whatever company, let's say that company grows 5 to 6% per year, which is kind of the average. Of that growth, 3 or 4% is going to be dividends, and the rest is going to be the appreciation of the value of the stock itself. Now, some companies pay dividends, and that is basically the entire growth of the value of that proposition, but others pay no dividends, but they grow in value a lot. So it depends on exactly how much cash you're going to need. And it depends on, again, your risk tolerance, because obviously tech is more risky and you don't have cash flow, but you have higher growth. So all of these things you need to answer for yourself. Let's say you have a portfolio of $200,000, $300,000, euros, whatever that you've built, and you know that you want to have 30% of that in dividend paying stocks because you want to have the cash flow to supplement your income. But obviously, dividend paying stocks are not stocks that grow a lot, that will enlarge your portfolio quicker. So you want to have another portion which is in tech stocks to compensate your growth. These are all variables that you will need to adjust when you answer these questions for yourself. There are people who are completely fine with having no cash flow from their stocks, only growth, and there are others who would have as much cash flow as possible because they want to live off of that money. Because obviously, if you want to live off of your portfolio, it is best to not sell portions of that portfolio, rather to just live off of the cash flow that it generates. Okay, and then bonus tips for things that you need to know is: do not invest into something you do not completely understand. The more you do not understand something, the more diversified that you need to be. If you are somebody who owns a transport or logistics business and you want to invest in other such businesses and buy such companies, you already have an understanding of what a good, solid company in that sector means. And then you can know that if you pour that amount of money into that investment, you can get X out. But if you're somebody who has no clue of that business, then obviously you should not be investing in that business, but you should be buying, let's say, an ETF or an index which follows the whole sector, because then your risk is more spread out. So diversification is key if you are a beginner, if you're somebody who does not understand this type of investments, because it means you are less likely to lose your whole amount as you are invested in an entire industry rather than a single company. And obviously you might have other investments. You might have your own business, you might have a home that you're renting out, you might have other side hustles, freelancing. All of these things should come into account when you're planning your portfolio, because if you have other assets that generate cash flow and you don't need cash, then obviously you can focus into building a portfolio which is more focused on growth. And of course, last but not least, there are costs and taxes to consider. If you are a beginner, the best thing would be for you to just buy and hold something, because the more you trade, the more you go in and out of positions, the more commissions, taxes, and general costs that you will incur, which will drag your portfolio down. Over a long enough period, these costs are actually a huge tax drag and can end up costing you six figures, if not more, depending on the size of your portfolio. Because obviously investments compound, but so do costs. And my advice to you as a beginner is to just stick to things that are simple. Do not trade, do not go in and out of positions, do not try to play the markets. Even expert investors struggle to play the markets. What chance do you have as a beginner? It will only generate costs for you, and it will only drag you down and stop you from growing at the pace that you want. Keep it simple, keep it slow, keep it steady. That is how you succeed in investing. Okay guys, so that is the end of this video, and we have part one, which you can watch here. And of course, now that we are done with part one and part two, you have a rough idea of what the markets are doing and also what you need to answer for yourself before you even open your brokerage account. Now, I have made videos on how to start investing before, and that goes more into depth of how to open an account and how to put in money, and you can find those here. But again, I will be making the third video, another step-by-step practical advice on how to invest your first $1,000 or euros, and how to set up automatic investing, how to kind of open your account and automate investing and simplify it as much as possible so that you do not think or bother with it too much. I know that for beginners, it is a huge struggle to kind of orient yourself into this world. There is a lot to consider, there is a lot to think about. So that is why you need to make it simple for you, because simple is easier to follow. Okay, so stay tuned for video 3, and thank you very much for watching. Hope you enjoyed and hope it has been useful for you. Till next time.